Hello and welcome to Sapphire. So latest on the Federal Reserve that its losses breached 100 billion mark as per the result of the central bank data which has been released on this Thursday, that they are likely to go a lot higher before the red ink stops. The US central bank is continuing to pay out more in interest cost than it takes in from the interest it earns on bonds it owns, and also from the services it provides to the financial sector. While there's considerable uncertainty around how it will all play out, some observers believe Fed losses, which began a year ago, could eventually as much as double before abating. So Fed captures its losses in what it calls a deferred asset, an accounting measure that tallies what it will eventually have to cover in the future. A money losing Fed has not been a surprise given its aggressive campaign to raise interest rates, which has taken a benchmark overnight interest rate from nearly zero level, as we all know, in the March 2022 to its current 5.25 to 5.5 range. But that doesn't mean that the losses will stop mounting, as the current level of short-term rates will drive up the negative income for quite some time. Instead, the losses will eventually stop, primarily due to the Fed's ongoing process of shrinking its balance sheet, which completes its rate hike process. The Fed also bought bonds aggressively during the coronavirus pandemic and its immediate aftermath, and in just over a year it has shed about 1 trillion in treasury and mortgage bonds. Fed's also officials have suggested that there are more to do on this front. The liquidity targeted by the Fed primarily exists in form of bank reserves and inflows to the central bank reverse repo facility. So the bank reserves have fallen about 1 trillion from their peak at the end of 2021 and stood at 3.3 trillion as per this Wednesday. So as far as our Indian market is concerned, we need to a very cautious approach, and two things to look out for. One is the dollar index. If the dollar index shoots up, it's a sign that Indian equity market will take a sharp fall or sharp correction. And also need to have a look at the bond market. If the bond prices goes up, that also suggests that the money has been taken out from the equity market and put into the bond market, which will again eventually result in the fall in our Indian stock market, Indian equity market. So these are the two indicators to look out for. So for traders, again the suggestion is to be cautious and wait for the right entry and the right exit opportunity. Thank you for watching the video.